Thank you, ladies and gentlemen, for staying on to the last session of the day. And without further ado, I invite my panelists over to be on the floor right now. First, a brief introduction of myself. The first part of my career is on facilitating beta products at the market operator, Hong Kong Exchange, to facilitate the development and launch of ETF from tracker fund all the way to what it has become today. Then I moved on to join asset management, to join Miri Asset, ironically, who's co-sponsor, who's the lead sponsor now, Global X of this event. Then I moved on to be head of Quantitative Value Partners before I become an asset allocation side on the asset allocation side. So may I invite my panelists, perhaps ladies first, to introduce briefly about themselves.
Hi everyone, thanks for staying here for us. I'm from S&P Dow Jones Indices. I'm Priscilla Look. I'm based in Hong Kong. My role is to head up the research and design of indices in Asia Pacific and for global as well. So before I joined, I've been with this index company for 12 years. Before that, I worked in investment banking, in agri research, agri strategies, in Deutsche Bank, Credit Suisse, Citibank, etc. So very happy today. I have heard a lot of presentation on quantitative topics. Is remind my memory when I was my previous as well. So hope that you enjoy the upcoming discussion soon. Thank you.
Okay. Hi, everyone. Thank you for your time for joining this event. I'm Max Land. I'm the ETF portfolio manager from the China Asset Management Hong Kong Limited. Actually, I have joined this industry for managing ETF for about 15 years, and I joined China AMC for more than 6 years. And so actually, I see the growth of the ETF market in Hong Kong, and we think that the ETF market will have very good, significant growth in the near future. So perhaps maybe I let the time to give the time to Dennis for his introduction.
Hi, thanks, Max. My name is Dennis Fogg. I am actually the head of fixed income ETF portfolio management. I joined Miri Asset, in this year, and then focusing on developing the fixed income investment platform. Before joining Miri, I have spent 15 years running both ETF and indexing strategies already.
Good evening. My name is John McCarrans. I'm the regional CEO for Northern Trust Asset Management. I've been leading our business here in the region for the last 7 years or so, just by way of Northern Trust Asset Management, global fund house, manage a little over USD 1 trillion in assets. I've been working with investors here in the region for over 25 years. It's a pleasure to be here and nice to do this in person for once. I'm sure everybody else has felt the same way today. Great to network in person.
Well, thank you. First, my first question is directed at John. What are the key trends in asset management industry in Asia today? And what are the unique features that you would like to highlight?
Thanks for the question. One of the things that we talked about as a panel before was providing a little bit of context as well on global versus local. We're obviously dealing with the same macro environment. We're dealing with the same geopolitical environment. And there are some themes that we've talked about today. So the separation of alpha versus beta is an interesting one, right? We've covered that all across the day today. Long gone are the days of hire an active manager for Go Anywhere Alpha, and then hire a passive manager for an S&P 500 beta exposure. Another one that we talked about a little bit over the course of today as well is performance chasing versus seeking specific outcomes. That's, again, a takeaway that we're seeing in the industry globally as well as locally. How do you think about achieving a certain spending rate as an institution, or managing your risk capital as an insurance company, or a specific retirement goal as an individual? So not so much chasing performance, but rather outcomes. Sustainable investing, again, a global as well as local theme. Going back to separation of alpha and beta, or going back to returns versus outcomes. Again, sustainable investing, a well-integrated program, can help you tick off a variety of those boxes and achieve your end outcome. And then we've also talked today about just the transition from traditional to alternative asset classes. Again, we're seeing that globally as well as locally. Hedge funds are back in favor. We're seeing increasing demand on the private debt side. I think maybe Mercer touched on that earlier today as well. And then also certain strategies like secondaries, for instance, where you're just getting an opportunity to buy into a certain beta exposure in the private markets, but doing so at a discount as certain investors are washing out of their various private investments. What I think is a little bit different maybe globally versus locally. So number one, I was at a CEO's breakfast, regional CEO breakfast last week, and the topic of what is sentiment or level of conviction concentration around Asia, China. And depending on where your vantage point is, you have a very different answer to that question. And some of that is based on the belief in fundamentals and resilience if we have an extended period of weak macroeconomic growth globally. Part of that is driven by the geopolitical environment. And then the other thing that I think is different globally versus locally as well, we talked a lot today around thematic ETFs and how you gain exposures. And one of the things, again, we maybe find a little bit different in North America, Europe versus the investors we work with in Asia, is probably a steeper demand curve for more thematic ETFs here than you see in other parts of the world. But that then poses the other question. You need to make the decision to get in and to get out. And many have a narrow theme and or a certain volatility profile. So how do you leverage kind of the more traditional beta building blocks, whether it's a quant active strategy or an alternative index strategy alongside some of the more thematic strategies? And at least in our experience here in market with the institutions and not-for-profits, wealthy families and otherwise, that blending, we've seen about a 3x increase in the quant active or alternative index strategies to then complement the thematic strategies and building a more sustainable portfolio. But I think that kind of covers at least the global to local from where I sit.
Thank you, John. Dennis, do you have any different views from John on this topic?
Yeah, sure. Thanks for the question and thanks, John, sharing about thematic ETF. That's totally something that I would like to share a little bit about, what's going on in thematic space. Global X is as you know, we issue lots of thematic ETF investment. As we can see globally, like in US, I think for thematic ETF, AUM has been jumping 10 times for the last 5 years, although the numbers still are relatively small relative to the whole ETF AUM perspective. Now it's around 150 billion. But as John's suggesting, a lot more issuer, a lot more investors, I think in both US and Asia are looking at thematic. From my experience, I say, I'm actually currently sitting in few, index advisory committee in both equities and fixed income. From what I can see, for the traditional market cap weighted indices is that, is focusing a lot more on free flow market cap instead of what's the true long-term, perspective, like structural growth perspective, how to drive, your portfolio performance. That's why lots of investors, when they are, investing in the market cap weighted ETF, of course, they are seeing a lot of short-term market information that can be consumed in the market cap weighted ETF. However, for some of the long-term structural growth themes, like for example, as you may know, for example, electric vehicles, a lot of these themes are underrepresented in the standard board-based market benchmarks. That's something that, as an ETF issuer, as an investor, we are looking more holistically how to create such thematic investment. The thing is that, one major differentiation between the thematic investment and traditional approach is that I think traditional asset allocation approach and investment approach based on, the traditional buckets like geographic, like sector, or, even some of the, building blocks. However, what we are thinking about thematic here is that, for example, for electric vehicles, we don't just construct a basket based on what car companies manufacturing, electric cars. But the thing is that, I'm sure, Priscilla, as an index vendor, definitely a lot of intelligence from the index vendor and also the ETF issuer have spent to try to find related, industry related to electric vehicles. For example, electric vehicles actually is a big consumer of the batteries. Then, let's try to include these companies into your electric vehicle basket. Another thing is that, for electric vehicle industry, the control system is very important. Let's try to include this. This actually involves a lot of different types of data. I believe that, given the development of the big data, in modern investment industry, that makes our job, like as a thematic ETF issuer, easier to construct a basket which is suitable for investors.
Thank you, Dennis. Well, I would like to engage the audience a little bit, and in an old-fashioned way, by putting up your hands. How many of you make use of beta solution, whether in the form of broad-based, thematic, or smart beta to use for your investment decision, either personally or in career? Those who use this beta solution or ETF, can you please put up your hands? Well, it's a good percentage, although there's still a lot of others who have not used. So what factors should or will encourage more investors in Hong Kong to make greater use of beta products? Again, this question goes to John.
By way of, I think, more use of beta products, maybe I'll split the market into the two broad buckets. So one being kind of the wealth, the retail side, and one on the institutional side. From a retail or wealth perspective, I mean, one of the things that I think we often talk about, and for some of the wealth managers in the room that we visited with and our clients, they're constantly on this question of how do we evolve our end clients or the individual retail investors? How do they think about investing versus trading? And that's a trend or a theme that you continue to see as a discussion point, which goes back to something I touched on earlier. Use of beta products today is a combination of thematic as well as strategic, but is it integrated? And I think over time, as retail investors are thinking about or migrating from a trading mentality to an investing mentality, you'll see greater and greater adoption, but then also more precise use of those different strategies and asset classes to improve and or to achieve said outcome on the back end. So as opposed to chasing the hot dot, the hot theme, what's headlining on Bloomberg, you're thinking about it in a total portfolio context, and that application we think is important. On the Insti side, Insti investors today are already utilizing a number of these beta products or strategies that I mentioned earlier. We've seen a massive uptick in our Quantitative, our alternative index, our smart beta strategies. But I think the nuance for that particular group is ESG integration or introducing a sustainability program. So we are constantly being tasked with our existing client base to say, can you take an old school MSCI World beta portfolio, and we want you to reduce the carbon intensity by 20%. And also we'd like you to introduce an ESG uplift by way of exposure to certain companies' themes. And by the way, can you also introduce an income enhancement relative to the conventional index? And do that all within a similar risk-return budget or risk-return profile to that of the parent index. And so it's not so much increasing the use of these beta products, but rather evolving how they're designed or utilized, again, to get at a particular outcome.
Thank you, John. Dennis, how about you?
Yeah, sure. Thanks for John for sharing. I would just like to touch up on two technical aspects of beta products. Personally, I believe that to actually encourage more users, both from institutional space and retail space in Hong Kong, to use more ETF product. I think the first most important thing for a lot of ETF issuers is that to have a single management fee structure in place. That's one experience I have been learning, from other developed markets like Europe and US. I think the popularity of the ETF product, in developed markets is mainly driven by the transparency. The things that I'm sure everyone has some experience in looking at the tracking difference, gross of fee and net of fee, and sometimes really cannot explain very clearly. So is it due to the portfolio management misway, or is it due to other factors, or even due to non-single management fee structure? I think as a thematic issuer and also very focused in developing the ETF business in Hong Kong, I think Global X for all our thematic ETF we actually have adopted single management fee structure. I think having this transparency for apple-to-apple comparison would make sure that every single ETF issuer has a fair playing ground for the investors to pick whatever they think suitable. Another thing is about liquidity. As a fixed income ETF manager, I believe that for equities it's very straightforward because the thing is that equities are trading on this exchange. However, when we go to fixed income, I think the COVID 2020 period actually, for example, like I'm sure, if you buy some fixed income ETF, even you're talking about the IG exposure, sometimes you see 5% discount and premium. How do you explain this? That's the thing that, we spend a lot of time, even for institutional investor, to explain, how we trade the basket, how much the liquidity, cost you would incur. Let's say, if you try to liquidate your portfolio in a more stressed scenario, and what kind of ways that we ensure the execution can source the best liquidity. For example, trading of the bonds. I think gone are the days when people just pick up the phone call to call 10 brokers to trade. I think these days, I'm sure, electronic trading is one thing that, we have been using. However, there are other ways that, you can get access to additional liquidity that I believe that people should pay more attention. For example, like portfolio trading. This is something that, very new in US and Europe. That's the ecosystem I think is evolving in Asia. I think these are the things that we try to educate both institutional and retail investors to understand a bit more before they trade the ETF.
Well, thank you, Dennis. We have also heard from the previous session that this year has been very difficult for everyone, and I'm sure many of you have felt it so far, individually as well as organization, in terms of organization, that the market has been very volatile, if not very difficult. About 12 months ago, the HSI was trading at 26,000, and almost every buy and sell side in Hong Kong were expecting HSI or Hong Kong stocks to outperform because it's still lagged compared to US stocks, which of course, if you use Dow Jones, was trading at 32,000 at that time. Of course, Dow Jones at zigzag, very volatile. But Hong Kong, in the last few days, we were very happy to see the index up from 14,000 to 16,000 plus. So, a lot of things happened in the last 1 year. But at the same time, if you look at the macro funds, they've actually outperformed because they are top down from macro factor before they go down into individual stocks instead of bottoms up, whether it's active or passive. So I would like to engage the audience in terms of which factor do you think is the most important in the next 12 months as a macro factor? There are 4, and later I will ask each factor for you to put up your hands. First, geographical tension, or even bigger scale war, let's say Ukraine, North Korea, and so on. Second, higher inflation, if not stagflation, resulting in much higher global interest rates. Third is a deeper recession in US, or perhaps Asia and the rest of the world. And finally, climate change. As you know, the water level is rising in many parts of the world, drought happening, and so on. So the first factor, how many of you think geopolitical tension will be the biggest macro driver in the next 12 months? Please put up your hands. Oh, yes, we are very lucky if this is true. Second, whether you think higher inflation or stagflation will be the primary driver in the next 12 months. Please put up your hands. Oh, okay. So most of you are afraid of higher interest rates. Third, deeper recession in US, Europe, and Asia. Please put up your hands. No? Well, seems it's quite optimistic lot in the audience today. And finally, climate change. Any of you think it's the most important driver in the next 12 months? No? Not at all? Well, in some ways, from Sichuan all the way to Shanghai, the water level in the Yangtze is 1/3 its normal rate. And latest, the salt water has actually moved inside the Yangtze from the sea. So, this is only one part. All over the world, in the last 12 months, there's been massive climate change. Well, anyway, it's good to get a feel of the audience. So, next question. which country or region do you expect to outperform in the next 12 months? First is China, second is US, third is others. It can be Asia, Japan, Europe, or Latin. So okay, how many of you think China will outperform in the next 12 months? Please put up your hands. Well, okay, we see quite a few. How about US? Well, not that many. So I suppose the rest are either no opinion or others, right? So, okay, with this, I would like to ask the panelists, what type of products Hong Kong investors can use to hedge the above concern and their investment preferences? And so for this audience, as we can see, it is interest rate risk. And probably, in terms of geographical, is neither here nor there, whether it's a few of China or some US. So I would like to ask this question, I pose this question to Priscilla.
Thank you. I think inflation, rising rates, definitely being the hottest topic we had when we talked to our clients. So actually, I think the previous speaker, I think we have presentation about commodities. Commodities definitely one of the asset class that will be a good tool for hedging inflation, as well as being a diversifier from your portfolio. Actually, I haven't been talking about commodities before because we have a low interest rate environment, stock market is really growthy, people are actually not playing around commodities for a while. But this year, in this inflation cycle, actually commodities have played out very well. We noticed that commodities in our study, actually historically, almost all inflation cycles, commodities are able to outperform. It had the highest inflation beta compared to any other asset class, and it's always moved up and down following the direction of inflation changes. So that is definitely one of the good play for inflation hedge compared to even gold or any other high inflation hedge fixed income vehicles. On the other hand, I think one of the reasons that people will start to be really chasing after commodities because it has the lowest correlation amongst the other asset class. That's why it's a very unique asset, even though it's not income generating, very different from equities, and it's not generating income, but its nature make it very unique. And so for this year around, we noticed that our S&P GSCI index, which is a broad-based production-weighted index, already up more than 30% already, where the stock market were down, especially for energy, because it's gained also traction due to the Russian-Ukraine war, it has stand out. So given the worry and concern about inflation, basically we have seen continuous interest on looking at different kind of commodity indices. One thing I just want to mention is commodity ETF indices are all not the same. We have as broad as GSCI index covering 24 or more commodity futures. We also have a single commodity futures ETF. We also have different kind of weighting method and rolling mechanism. That's why I just feel like the market has become more interesting so that clients can look for what is the play out strategy they want to get and look for the commodity indices or ETF they're after. The next one would be infrastructure. Actually, infrastructure is also been really hot topics when we spoke to our clients because infrastructure, even though it's equity, but if you have to put your money somewhere, infrastructure play definitely be one of the most interesting one about inflation hedging because infrastructure, their cash flow, usually they are linked with inflation and their cash flow is very steady and they also generate income. And for example, for our S&P Global Infrastructure Index, which composed of about 75 companies from infrastructure, year to date, they were only down 5%, whereas the global equity markets everywhere are already down 20 or 30%. That's why it's another interesting thematic to look at. And one thing I almost want to raise my hand when David asked for climate. Climate is actually one of the risks which is so apparent to all of us here, but we are taking least action so far, especially maybe in Asia. Indeed, this is quite a big damage because you may think about, even in the previous speaker, they talk about carbon efficient low carbon. But I think the world now is already, if we look at the products in Europe and US, or even starting to see in Hong Kong, we have seen a lot of investors, they are actually seeing climate change is a big risk because the physical risk is very acute. It's not like a long-term transition risk. It's not like a long-term transition risk that you can wait until 2030 or 40 or 50, but you can see the physical risk already damaging the corporate profits when they have exposure by flooding or drought, not only agriculture business, but where they put their warehouses. Even, I think my company back in several years back, there is hurricane, our office like being flooded. So it's actually more serious than people think about. It's very immediate, need to be fixed or need to be addressed. And we have seen in Europe, actually, a lot of investors, they start to replace their core asset allocation by integrating not only ESG, but more on climate transition into their portfolio. And actually, it's not a thematic, it's not like a funky thing. It's more, if you look at the index, it's very boring. The performance most likely is very close to the underlying benchmark. But the key elements, that is the index where the companies were screened and weighted, they were evaluated by their carbon footprint, like what the previous speaker mentioned about the Scope 1, Scope 2, or even Scope 3 carbon emission. And also nowadays, given that people are looking with more common ground on the net zero alignment, a lot of a trajectory by scientists already set up so that we have estimates on what is the carbon footprint trajectory if we need to align with net zero. The EU benchmark regulations also set up minimum standard for us to build a benchmark so that you can see if I need to make sure my portfolio, the way I invest in companies, the way they allocate assets is aligned with a net zero commitment. What can I do? So many of these are optimized indices, and they align with several elements. Either they have a certain percentage of carbon reduction compared to the benchmark, or they have aligned with the net zero alignment criteria so that you receive a label for your products. And this is important, not only that you want to avoid companies that are facing very big physical risk or they have very poor carbon footprint. That might be fine by companies or being hit in their corporate profits by increasing stringent regulations on carbon emissions. But also a lot of investors, actually, they are signed up for responsible investors. They have to align with these mandates. And that's why I just feel like we should really be more aware and pay attention to this type of new index or new data set available on these measures, even though we might not be putting money immediately, but it will definitely going to come in the market.
Thank you, Priscilla. How about Max?
Yeah, I think most of us agree that the most significant factor that affects us in the past 1 year and the future 1 year is the high inflation that leading to the high interest rate. Actually, it is more a problem of the Western world, such as the US and the UK. And actually, I think the main reason for the high inflation and the sustained high inflation is due to the deglobalization of the world. For example, the rebuilding of the manufacturing plant outside China may make the cost significantly higher. The bring back of those high technology companies back to U.S. may also increase the labor costs. Also, there are other factors that will also increase the cost for us, which increase the inflation rate. Maybe the ESG and decarbonization. Actually, we know that we aim for decarbonization, but actually there's a cost for doing that. So in the long term, I think that the inflation rate will be kept steady at a relatively high level than in the past. Maybe in long term, maybe 1 or 2 years later, it may be still keep at 3 or 4%. And we also know that in the short term, the reason for spiking inflation is maybe due to the geopolitics tensions like the Russia invasion of Ukraine and the tension, the Taiwan Strait tension between mainland China and Taiwan. And also there's also some other factors like the COVID pandemic that affect the supply chain. So I think for such short-term factor, that is like the geopolitics tension and the pandemic, this factor can be solved in the near future. So I don't think that the inflation will keep at a very high level, but 3 to 4% of inflation rate will be expected. And so we expect the U.S. interest rate will not be very high because what the short-term factor will bring down the expected inflation. So as we see that the stock market already dropped 20 to 30% this year. And I think to hedge against the inflation is already the time to step into the market and invest in the stocks market. But we may have to pick pick some factors that we are going to invest. For example, in the initial phase of a high inflation environment, commodity may be a very good investment to hedge against inflation, but I think we are entering the second stage of the inflation. So when the stock market is now traded at a relatively low valuation, for example, Nasdaq 100 index was trading at 38 times early this year, and at this moment, I think the index already traded at 22 times. So from valuation perspective, I think it's already time to enter into the market. To hedge against inflation, we have to invest in some companies that have good cash flow and maybe companies with higher dividend payout will be our target of investment. Actually, we see that some institutions we invested this year have the interest to invest in some smart beta ETF. For example, we see that there is an Europe ETF that is picking the high quality stocks with high return of equity and sustained earning growth. And also, there are some high dividend ETF products in the market, and we think that these are some products that investor can consider to hedge against their inflation risk. And also, we see Nasdaq 100 is also for long term, we see that growth will come back, in fact, and we think that because for companies like Apple, they can pass through the cost to the consumer. So we don't think that the inflation risk to such kind of large cap technology company will have a very bad impact to them. And so also we see that there are also some FX hedged ETF on the market that brings relatively good return to the investor. For example, we see that there's an Japan ETF with currency hedged to US dollar. The return this year so far is around 0. So in an investment environment that the global index dropped for 20 to 30% a zero return is a very good one already. And actually, we think that at this moment, because the inflation is more and Western problem, like in the US and in the Europe, we can actually avoid investing in those countries, but come back to invest in China and Hong Kong. Because the impact of the inflation to China is actually not quite significant. We see that the inflation rate in China is still low, and China can still keep a loose monetary policy. And so with a very low valuation and many factors already pricing, like the Ukraine war, the U.S.-China tension, and the intervention of the government on some different sectors like technology, education, and property, and many negative factors already priced in. So we think that for international investor, they may consider to diversify their portfolio by investing more in China equities. And for Hong Kong investor, if they are already concentrated with their investment in China, they may also consider what I mentioned, like those countries that are less affected by the high inflation, for example, Japan.
Well, thank you. In the interest of time, we have one last question for the panelists. Is Asia lagging behind in impact investment, ESG or impact investment? And what are the next steps for this strategy in Asia? I know, Priscilla, you are very passionate about this topic, so I'll come back to you again.
Yeah, I think Asia definitely lagging behind Europe, but actually we are not that too far from the US. Actually, around the world, I think the most popular ESG, I would not say popular, that the most concerned about ESG is in Europe. We have seen actually there are a lot of ETF, there are a lot of core asset allocation, like what I mentioned, they're replacing their core with ESG or climate index already. But actually in Asia, we're also seeing rising interest from investors on ESG from starting 3 years back, I would say. From initially, they don't really know what to ask, what they should know, but now they really know different strategies. For example, in Australia, actually, we have seen some ETF sponsors, they are switching their benchmark from core asset plain vanilla equity index to a ESG screened ETF, or to optimize climate efficient ETF index, so that they are not launching a new product for this, but they are changing their benchmark for a ETF with significant size, rather than just buying, say, S&P emerging markets or developed X or Australia, whatever, but buying into a carbon control index. It is actually very aggressive, because they are basically switching over everything. So for this, and it is actually is not even simple to understand sometimes, like carbon control basically is an optimized index, so that the index excluding some companies like thermal coal or controversial weapons, etc. And they do optimization so that the index achieves certain percentage of carbon reduction compared to benchmark. But of course, they have done their consensus consultation, and the investors really welcome this kind of strategy, because at the end, the portfolio able to maintain very low carbon footprint, a reduction significantly better than the benchmark. At the same time, the return trail is very similar to a core asset allocation. Normally, these indices are talking about 2% tracking error, which is very acceptable by a lot of investors. And even stock exchanges are also actually starting to require this kind of requirement. For example, Japan Stock Exchange, they have a big market reform, so that for their listing requirement, they have added one element around ESG, that the company need to provide high transparency on their ESG and climate exposure, on their climate reporting, which should be aligned with international standards such as TCFD standards. And things like New Zealand, we have seen that the super funds actually having set up some regulations so that they have to exclude, say, UNGC violators or companies with energy or with fossil fuel reserve. So we have seen this definitely is going to result in a change in the investor so that they will look for this kind of strategy going forward. So I think one of the biggest area we have seen is pension fund as well. We all know that pension fund, they are able to invest for longer term. They don't need to worry about short-term volatilities. That's why they're more committed. For example, Japan, GPIF, they actually have actually 12 trillion yen of assets tracking ESG indices, and 1.6 trillion yen tracking green bonds, sustainable bond, etc. That's why they are really putting real money behind this ESG investing. And we have seen increasing number of clients also planning to launch ETF or products in the region so that they can track indices, looking at net zero alignment, as well as lower carbon footprint, or indices with a ESG uplift by reweighting companies. But the bottom line is they all need to have a very low tracking error so that they are not taking extra active risk when they are trying to become a more responsible investors tackling ESG risk and climate risk.
Well, thank you, Priscilla. In the interest of time, since the organizer, is chasing us, we are way behind schedule. So with this, I will end the session now. And thank you very much for coming and staying all the way behind over time. And I wish you a pleasant year ahead in your investment and also for the entire asset management industry. And hope to see you again next year, in Hong Kong as well. And perhaps everybody without masks by then. Thank you. Bye-bye.
Thank you.